And the more the Fed raises rates, the more of a problem this is, the more Frankenstein monster gets angry. And the only thing the Fed can do is to stop this, but then it would have to unleash all this liquidity that's been hidden in its balance sheet into the real world. And can you imagine what would happen then? Saturday, April 15th, 2023, Maneco 64, home of alternative economics and contrarian views. Today, we're going to look at Ben Bernanke's Inflation Frankenstein. Yes, Ben Bernanke was the main culprit, the man behind all the QE that we've had since 2008. And now this Inflation Frankenstein is waking up. And yeah, that's what we're going to focus on today. Before we go further into the topic, just wanted to say that after we finish covering the Frankenstein, we're going to look at some UK news about strikes, about inflation, and I want to cover that and look at the definition of inflation, because I think a lot of the nurses and doctors as well, and rail workers, rail transport workers that are striking, they're gonna the Bank of England and the politicians, they're gonna blame them for inflation. So we need to look at that because it needs to be done. And we're also gonna do some questions, Q&A, that you've asked in the comment section that I couldn't answer in the comment section from last week, not this past week just gone, but the week before. We have a few questions. If you want to stay tuned in to the report, that's what we're going to be doing. So Ben Bernanke, Frankenstein. Why Ben Bernanke? Why am I ganging up on a Nobel Prize winner in economics? Well, because he's been in my crosshairs, so to speak, since November 2002. Back then, I had just started buying gold. I think I started in the summer of 2002. My wife and I decided to diversify away from equities. Our private pensions were all in equities. And we bought some Krugerrands, and I started looking into gold and holding that gold coin for the first time. I'd never had a gold coin before. Really got me interested in gold, and I thought to myself, how come I never bought one before? We should have more of this. And I did all the research, and I've been doing it ever since, reading about history of money, central banking, and I recommend, of course, The Creature from Jekyll Island, and even more, I recommend also The Secrets of the Federal Reserve by Eustace Mullins. There's loads of good material there. There's The End of Fed as well by Ron Paul. That's a very good book too. But yeah, back in November of 2002, Alan Greenspan was still the chairman of the Federal Reserve. But Ben Bernanke was coming up the ranks, and he was expected to become eventually replace Alan Greenspan. And when I saw his remarks to the National Economist Club in Washington D.C., it raised alarm bells. I could hear the alarm bells, and I think now this Inflation Frankenstein is coming home to roost. So I'm going to put a link to this speech he made back in 2002, and he said deflation, making sure it doesn't happen here. And it's amazing that some people are still worried about deflation. And if you wait until I talk about what's going on in the UK, you understand why a lot of this talk of deflation is just baloney. But one of the most interesting passages here that got me like, wow, I need to keep accumulating and stacking not just gold but also silver was this. What has this got to do with monetary policy? Like gold, US dollars have value only to the extent that they are strictly limited in supply. But the US government has a technology called a printing press, or today its electronic equivalent, that allows it to produce as many US dollars as it wishes at essentially no cost. Yes, that's the key word there, no cost. You're wrong, Ben Bernanke, and we're going to come to that in a minute. By increasing the number of US dollars in circulation, or even by credibly threatening to do so, the US government can also reduce the value of a dollar in terms of goods and services, which is equivalent to raising the prices in dollars of those goods and services. So it's a policy, it's a government policy. It's not Putin that's created inflation or greedy business men and women. It's the US government with the help of the Fed. Bernanke admits it. We conclude that under a paper money system, a determined government can always generate higher spending and hence positive inflation. So there you go. So now I'm going to jump to this article that I saw. It's an opinion piece, and it's not on Zero Hedge. It's on Fox News. And it says this $6 trillion problem threatens to push inflation even higher. And this is by an opinion piece by E.J. Antoni from Fox News. With each monetary manipulation, the Fed digs itself and the nation deeper into the hole, not just the nation, the whole world. Could it be that the BRICS countries are trying to move away from the dollar, not just to be more sovereign, but also because they know what's coming? I think it's possible. So let's go through this article. I thought it was really good. And then I'm going to show you some data from the Federal Reserve so you can compare how things were back in 2004 and how they're now. Following the 2008 global financial crisis, the Federal Reserve created trillions of dollars to ease financial conditions and keep banks afloat. Many economists predicted record inflation would result. But Fed Chairman Ben Bernanke pulled an ace out of his sleeve. He paid banks to park much of that money at the Fed and limit its inflationary effects. That victory was evanescent. And now the bill is coming due for the Fed's quarantining almost $6 trillion to keep a lid on inflation. So there you go, Ben Bernanke. There is a cost, and we're feeling it right now. The multi-trillion-dollar corner that the Fed painted itself into is now costing $275 billion annually, more than the Treasury spent on all veterans' benefits and services last fiscal year. And it's going to get worse. Paying interest on reserves sterilized the money because any cash kept at the Fed was not being lent out by banks and therefore wasn't multiplying as it normally would through fractional reserve banking. But the inflationary pressures from Congress's deficit spending has put the Bernanke model of sterilizing money on steroids. So yeah, deficit spending, it's going to keep going strongly, unfortunately, until 2033 at least, if we get there in terms of the current system. In the spring of 2021, the Fed began ratcheting up its reverse repurchase agreement operations, or reverse repos. These are short-term loans to the Fed with Treasury securities serving as collateral and provide quick but not lasting adjustments to liquidity levels in financial markets. Reverse repos are a way to rapidly but briefly take cash out of circulation and keep it at the Fed. Conversely, if the Fed simply sold the securities in open market operations, the money from those sales would just cease to exist, which puts upward pressure on interest rates, including those for new treasuries. Reverse repo operations combined with interest on reserves has turned into a multi-trillion-dollar attempt to solve the problem of creating money for the government to spend while minimizing the inflationary impact. Well, basically the Fed and the government want to have their cake and eat it. That's what it is. And we're going to come to the comparison in a minute once I finish this article of the data. Currently, the Fed pays over $750 million in interest every day to banks, hedge funds, and other large financial institutions that have parked $5.7 trillion in its vaults. A year ago, that daily interest payment was only $18 million. Well, how come? Well, because rates were at zero, and now rates are approaching 5%. But that was then when the amount needing to be sterilized was much smaller and when interest rates were much lower. And here we go. Now, like Frankenstein's monster, the Fed's anti-inflation inventions are turning on their creator. The interest payments are adding $750 million to the money supply daily, working at cross purposes to the Fed's higher interest rates, meaning higher rates would be needed to stop inflation snowballing. At this point, the Fed has no exit strategy. So if it stops paying interest on reserves and running massive reverse repo operations, it will immediately add $5.7 trillion of liquidity to the market, about 25% of the entire money supply. The extra liquidity would unleash an inflationary tsunami dwarfing that of the 1970s. The Fed's dilemma manifested in September 2019 when it lost control of the repo market. Yes, and I spoke a lot about that repo crisis. I'm going to put a few videos up in the cards that I made back then about the repo crisis. Subsequently, the federal funds market, in a panic attempt to regain control of interest rates, the Fed abandoned prudently reducing its balance sheet, begun less than 2 years prior. Yeah, and I think the balance sheet was around just below 4 trillion at the time. Now we're near 9 trillion, so it's going the wrong way. Hedge funds and other financial institutions learned two valuable lessons in 2019. U.S. Treasuries are not risk-free when it comes to losing value, and the Fed is still in the bailout business for financial markets. Treasuries are often pledged for multiple loans, rehypothecated. Well, that's lent out many times. One treasury lent out many times, mimicked fractional reserve banking structure of pretending a dollar is in two places at once. Just as a bank collapses when too many depositors try to get their money at once, if multiple parties try to sell the same rehypothecated treasury, the financial system runs out of funds. With the latest bank failures, institutions failed to hedge the interest rate risk of treasuries, and the Fed again stepped in, offering to take those devalued securities at par as collateral on new loans. Sterilizing trillions of dollars by paying banks and hedge funds to store it at the Fed has hidden the inflationary impact of money creation, but also caused misallocations of capital and planted systemic risks in the bond market. As the Fed now pairs rate hikes with a return to money creation via its balance sheet, it is effectively attempting to control the yield curve and further distort the economy, storing up yet more trouble for the future. With each monetary manipulation, the Fed digs itself and the nation deeper into the hole. The central bank needs to face reality instead of trying to warp it. You cannot spend, borrow, and print trillions of dollars and expect no negative consequences. Right, Ben Bernanke? No cost. The sins of the past always catch up to you, be they moral or monetary. So there you go. I thought that was really good. And I'm going to put a link to it below in the description for you. And I just wanted to show you what this really means, what Mr. Antoni was talking about. We're going to go back to December 29th, 2004. And if you look under the Fed's balance sheet here, combined balance sheet of all the regional banks under its liabilities, you can see that most of the liabilities were Federal Reserve notes, right? 722 billion 904 million. Reverse repurchase agreements, or these reverse repos, they're only just under 30 billion. And under deposits as well, if you look depository institutions, the total was 21.4 billion. So just keep those numbers in mind. And we're gonna jump into the future, into the present day, and we're gonna look at the same numbers. The presentation is a little different from the Fed, but as you can see, the reverse repurchase agreements or reverse repos, now they stand at 2.676 trillion or 2,676 billion. And the deposits to the depository institutions, they gone from like 21 billion to 3.347 trillion. So that's what Mr. Antoni is talking about. And the big problem is the interest rates rising. And the more the Fed raises rates, the more of a problem this is, the more Frankenstein monster gets angry. And the only thing the Fed can do is to stop this, but then it will have to unleash all this liquidity that's been hidden in its balance sheet into the real world. And can you imagine what would happen then? We already have rising prices these days. I think it will get even worse. And that's why I like to give a shout out to my precious metals affiliates, ITM Trading in the US, and also Miles Franklin in the US, and Gold Investments in the UK. If you want to find out more about them, go to the description of this video. So there you go. Things are going to get very interesting. And is it any wonder people are trying to move away from the dollar? And I think you should as well. But that's just my opinion. So back to the UK story I talked about. As you can see here, there's a story from yesterday in the FT. Nurses in England to stage biggest strikes yet after rejecting pay offer. NHS in limbo after Royal College of Nursing calls for 48-hour walkout affecting critical care. So I'm going to put this article as well below in the description for you to read under archive.ph. But one thing I wanted to talk to you about is that the deals they've been offered here are about 5%. Not more than 5%, not just for the nurses, but also for the RMT workers. And we know that CPI in the UK, and that's like understating, I think, the rising prices that we've seen, the rising cost of living, that's still at 10%. And if you look at RPI, the retail price index, which is a much better indication of the rising cost of living for the average household, that's almost at 14%. So if they're offering you 5% pay rise annually, you're still losing out at least 5%, maybe even 10%. Is it any wonder that these people are on strike? The nurses, we've seen the junior doctors, the rail workers, and many more. And I don't think it's going to stop because the government has cornered itself, because it's been inflating and creating currency out of thin air with the Bank of England deficit spending. We have the same problem in the UK. So we're going to hear a lot, especially from Andrew Bailey, from others in the mainstream media, business, that these people are creating the inflation, but they're not, of course. This is just a consequence of the currency debasement. So with that, I want to turn to my old Webster Pocket Dictionary from the 1970s to the definition of inflation, which had not been as corrupted back then. So it says, an abnormal increase in the volume of money and credit resulting in a substantial and continuing rise in the general price level. So there you go. So it's not CPI or nurses or train drivers or junior doctors or whatever kind of wage earners that cause the inflation. It's the government that causes the inflation. And with that, I'm going to turn to Felix Sommery, who was probably the most influential banker of the first half of the 1900s or the 20th century. And this is what he said. Felix Sommery, aka the Raven of Zurich. The state alone is responsible for inflation. Inflation without government, or indeed against government, is impossible. So there you go. I hope one of these nurses watches this video and tells her friends about it and tells others about it. So now we're going to go to some Q&A from just over a week ago or so. There's not too many of them. There's 5 questions. So this is from not lifting the debt ceiling would be catastrophic. That was an interview I did with Clive Thompson, beginning of the month. The question is from Inflation Millionaire. Do you think the UK and the USA will confiscate gold? If they did confiscate gold, would it destroy the gold industry? Think of all the mints and bullion dealers that would be nationalized or forced to close. What about gold held in private vaults? Anything is possible. In the UK, they never confiscated gold. They made it. They limited the amount you could buy from around 1966 to I think the mid 70s. In the US, of course, in 1933, President Roosevelt signed Executive Order 6102, and I think about a quarter of Americans handed in their gold. But yes, anything's possible. But back in those days, gold was a lot more important for the system, I would say. A lot more people held gold. But as I said, anything's possible. Would it destroy the gold industry? I don't think so. The mining industry, it wouldn't. Actually, one of the biggest beneficiaries of the Great Depression was homestake mining. I think it went up 500% because governments still needed gold. But in the UK, gold sovereigns and Britannias and all the silver coins, coins of the realm, are legal tender. And I think a lot of the elites, the people in charge, have those as well because they know what's coming. So I'm not sure they'll do it here in the US. That's possible. And there was a way around the confiscation in the US, the banning of buying gold in the US, and that was through collector's coins, numismatic coins. That could be scrapped, of course, but it's still something that you could consider. But I would say, yes, they could come after anything you have. So it's not a reason to keep stacking, in my opinion. So I hope I answered your question there, Inflation Millionaire. Second question is from Credit Suisse and the war against Swiss culture. This is from a question from Ivan Garcia Novaes. It says, "Dear sir, in which countries is gold a legal currency? If that is the case, why on devaluing currencies citizens have to pay for capital gains?" Well, I guess gold sovereigns are a legal currency in the UK, and there are no capital gains taxes on legal tender here. So there you go. I don't know where you are, but here in the UK, gold sovereigns and Britannias, and also the silver Britannias, they're all legal currency, and there are no capital gains. Credit Suisse and the war against Swiss culture again. This is from SoCal Silver. "Hi Mario, dollar weakening causing AUAG to get attention. Everyone getting excited again, pushing the relic higher. Will 2023 be the year gold reaches new highs? If so, what will average people do about it? Sell it for fiat, buy land, buy investment property? Decisions. Cheers from SoCal." Well, we saw that in the last 2 days, Thursday and Friday, gold did get to near the all-time highs of 2070. I think the high the last couple of days was around 2050. Yes, it's come back down, but I don't think it's over by any stretch of the imagination. And you need to think of the currencies getting weaker, and that's what's happening. Yes, I do see the dollar and all other fiat currencies getting weaker versus gold in 2023. And I think you need to think of gold and silver as savings for a rainy day, or for an investment opportunity that you think is worth putting through. So that's what I say about gold and silver. I'm not setting a date to sell my gold and silver in 2023 and exchange it for another asset, but you might want to do it. Everyone has a different circumstance. So I hope that answers your question, SoCal Silver. "The world needs sound money and not a new Bretton Woods." It's from that video. It's question 4 by Gary Emendem. "Thanks for a great video, Mario. You mentioned in the previous video how you invest some equities in your ISA. Would you be able to do a video on this, or is this a request that could be fulfilled as part of a Patreon donation?" Well, I mean, there's not much of a secret. I've spoken about my ISAs. I basically buy gold and silver miner producers. I've got Newmont, Barrick, and a few other major silver producers, and a few junior miners that I look into. And that's about it. I guess if you join the Patreon, and I think it's the minimum is like $1 a month. Yeah, I could answer some more questions and details for you. And it wouldn't be advice, it would just be my opinion, of course. So here's the last question. "The world needs sound money and not a new Bretton Woods." This is from Kilted Sasquatch. Question 5. "If when the dollar collapses, how will any asset be valued? Everything from food, gas, nuts, and bolts. Shares of stocks or cryptos are currently priced in dollars." Well, they would be priced in whatever people are using more as money. And I would say gold and silver came before the dollar. So people will price things in grams of gold, or grams of silver, or ounces of silver. People will find a way. And usually it comes back to gold and silver. So there you go. With that, I'm going to wish you all a very good weekend. Take care. Bye.